Now, silver was at 14,265 at the time, before rallying over $5, about 550 actually, up to 19,750.
All right, now, Andrew, with so much happening, and what are the most notable events that you've been seeing over the last 2 weeks? It just seems like such a long time ago because there's so much going on. Maybe you can bring us an update on what you're seeing.
Yeah, Shane, other than you sitting under that lovely tree, there's been a myriad of cross currents out there. But look, our aim, though, our aim here is to provide our subscribers with information that officials and their agent insider banks do not want you to know. Now, the gold war really has escalated significantly following the June 26th G7 Russia gold sanctions. Now, our focus, though, is on how this officially sanctioned wall of paper market selling, and you only have to look at any chart to see it, is causing an arbitrable disconnect, which is being capitalized on in the underpriced, tight for supply physical markets. And while the blinkered speculators trapped inside this casino with their oxygen and no windows basically do not see what's going on, what they've done is taken the bait. And wholesale market footprints, 100% evidence, competing sovereigns, central banks, but also notably Indian buyers who have pretty much tripled. We're pretty sure they've tripled their usual 30 tons of smuggled gold per month to capitalize on the very active 30% discounted physical gold for oil trade, which is alchemizing paper gold into physical at a rate we've not seen. Let's just take a little time to walk through this, as we haven't evidenced the house so loaded long against their customer specs, which is so similar to as they did just before they pulled the trigger on similar bets against the house back in May 2019. And as we know, the house always wins. And look, long or short, they will maintain their 95% win ratio that every casino maintains, and every single there's very few games in a casino that cannot be controlled as a 95% win. Now, currently, this COMEX-driven arbitrable backwardation, you know what backwardations are? It's when we see a huge disconnect, a cheaper price in a further out forward contract or a further out COMEX contract, i.e. for settlement in a future date, and we see a price that is significantly below what the cash price is today, what we have to pay today. And what this has done, these are so enormous, it's really led the house to really exposed by the thing they don't really want to happen here, which is there's an exchange for physical. Now, once we got that term back out the way, we've been through it many, many times, but essentially the COMEX, you can create a little contract called an exchange for physical, which is deliverable which can transit into the deliverable markets in London, for example, the over-the-counter markets. Now, what's happened is these COMEX insiders have been exposed to these EFP delivery outflows. Now, and they've been steadily going long against every single blinkered spec, because the blinkered specs have sell orders that consistently come in. They think that there's a downtrend that will go on till zero, essentially. They're always going to be wrong at both ends. And this is the point we're trying to establish. It's coming very, very close to one of those ends. And really, what happened and the reason I draw attention to May 2019 is what the structure, it mirrors, what we do is we're mirroring a spec short position against the house not seen since that date. And where was gold? Gold was $1,269 at that time. Then it rallied close to $300 to $1,566, with very, very little in the way of pullbacks, which is typically the case when you've got a short squeeze. We've had a long squeeze and you get very little pullback, and now you're going to have a short squeeze with very little pullbacks. That's what happened. And it went all the way from May to September 2019 as the House rang the register on really what was, again, very wrong-footed specs. Wrong at both ends. Same in silver, except insiders are far more reluctant to extend really already unprecedented September backwardations, which we've observed reaching, this is key, a $1,400 discount per contract to cash silver. Now, silver futures also reaching similar spec wrong footing against the House not seen, again, since May 2019. Now, silver was at 14,265 at the time, before rallying over $5, about 550 actually, up to 19,750. Very little in the way of actionable pullbacks for that next 4-month period as specs were rinsed. So what we're saying is that structure is remarkably similar. In fact, even more so bullish. So Shane, let's step through the footprints leading to this structural setup, because it's really important. So following the G7 meeting on June 26th, it was, with gold ranging, gold had been ranging around 1840, 1880, but liquidity providers now confirm that official selling in paper gold, which we reported had begun in our last episode, which was directly attributed to the Russia gold and gold oil sanction, has stepped up notably since. But COMEX Central exchanged for physical contracts, which directly feed into the Basel III compliant spot FX gold market in London, are rapidly draining the tiny fraction of real COMEX physical underpinning a ballooning, unsustainable, increasingly underwater, naked short COMEX gold market position.
On our last episode, you just brought it up again, but on our last episode, you drew our attention to something I haven't heard anyone else talk about, and that's the large Indian market gold smuggling. What are you seeing in the last couple of weeks on any developments in that area?
Yeah, Shane, and as we've been tracking, the Indian gold for oil trade has significantly ramped up, smuggling large tonnage-sized gold inflows, which adds an additional drain on the already tight global physical market. And as was really expected, following the Indian tax increases, smuggled gold ramped up. But this comes on the back of the likely tripling of the 30 tons per month that the World Gold Council estimates. So somewhere in the region of about 90 tons. Now that extra 60 tons of capacity is pretty darn relevant, because at the margin, it is sucking gold out of the global physical markets. Nothing to do, limiting also what is able to be flywheeled by the LBMA, even though that is ring fenced. Now, bottom line, with this additional physical demand, this G7 sanctioned paper to physical gold market disconnect is in the process of blowing back on officials.